everyone for coming. Sorry I can't be there. Say it's okay. All right, so first off, we'll get approval of the meeting minutes for April 13th.
I'll make that motion.
Second.
Okay, any questions, comments? All in favor?
Aye.
Okay, and next I'd look for an approval of the May 9th meeting minutes.
Motion.
Second.
Any discussion? Everybody's good, all in favor?
Aye.
Aye. Okay. Next I'm assuming, I don't see them, but I'm assuming that someone from Gorman is there.
Yep.
Okay,
We have Bo Travis and Hank Miller.
okay, thank you.
You can, yep, go ahead.
You don't have to be on camera. We noted you're here. You're good.
Yeah,
I handed out a handout that has some of the financial highlights, so let's just go over that quick.
Melanie, can you hear okay?
yep, I can, thank you. I just turned my volume up a little.
Just wanted to make sure.
So that first, on that front page you got there, that first is your general fund. And this is a little bit of a budget to the actual breakdown of where you ended as of December 31st, 2021. So June 30th, sorry. You had total revenues, you budgeted for about 64 million, your actual came in about 67 million. So you had a positive $3 million that came into the district, and most of that was the additional federal funding that you guys received. Total expenditures, you had you budgeted 66 million approximately, and your actual was 64. So you spent less than you budgeted for, 1.2, leaving you with a normal operating surplus of $5 million. Now you did use that with your other financing sources by transferring $5.1 million to the capital reserve fund. So that did put your net change in fund balance of a deficit of 2,286,899, leaving you with an ending fund balance as of June 30th, 2021 of 17,939,494. Okay, now that fund balance is broken down for the general fund, and these are the categories that you guys did. Now, non-spendable, which you didn't have any, but that would be, prepaid and inventory items. You have, because of the changes in GASB 84, we had to move some of the scholarships have to come into the general fund. So there is scholarship money that's sitting in the general fund, and that's a total of 212,648 as of June 30th. You did make commitments to the fund balance for the anticipated increase in retirement contributions, 3.5 million, and future debt service payments of $2 million. For assigned fund balance, that doesn't have to be board approved, but it could be by management or by other budgetary means that you guys do. And you assigned a capital fund transfer of $3 million for future projects. For student activities, again, with GASB 84, shifting some of student activities couldn't be considered custodial funds, and they needed to be incorporated in the general fund. We do have some student activity fund balances that would automatically give them a designation of assignment of 61,649, and then to balance the 21-22 budget of 4,729,906. Leaving your unassigned general fund balance at the end of the year, 4,435,291. The next page, I just did like a food service trend analysis of where you are, because food service is kind of tricky. So like your governmental funds, with the general fund, it's a little bit easier to understand. You modify accrual. All right. You're not full accrual. You do have some accruals, but not the full accruals with the full bond payments and the your capital projects and all the debt service. You don't have your pension and OPEB. That's on your government-wide statements. There's those reconciliations from those beginning statements. But so when you guys do your budget, you budget it based off the general fund, off modified. Where you're not taking the actuary liabilities of PSERS plans that are going down. All right. So the food service, though, because it's a business type activity, it's accounted for as a business. The PSERS and OPEB obligations are booked inside the food service fund. Okay? So when you look at this trend analysis, you're looking at your operating revenues, meaning monies you collected in versus what you paid out. Your non-operating revenues, that constitutes your federal and state subsidies from the National School Lunch Program. That's the money coming in. So your change in net position at June 30, 2021 was a negative 108,786. Now to kind of trend that back to getting rid of the cash items or adding them back, the non-cash items. So you had a change in PSERS liability of 88,000 that negatively affected the fund balance in there. Your OPEB of 3,723 and depreciation of 10,994. So your cash difference is 6,048. You add those cash items back. It just kind of helps you trend out some of that PSERS and OPEB that's changing on balance over time. The last page I summarized for you is your other governmental funds. And you're mainly your capital reserve fund and your capital projects fund. You can see that transfer from the general fund of 5,149,555 is in there. So leaving your capital reserve fund with an beginning balance of 6,429,938 and ending in 10,850,160. And your other capital projects fund that you're working, your ending fund balance of $1.9 million. Okay. Jumping into the audit report. Just gonna go right to the table of contents here. Just explain what you're looking for when you're reading through this. Excuse me. So right at the beginning, you're gonna have the letter to governance or management, pages 2 through 6. In that letter, you have us explain what we discovered and what we found during our testing of the audit. Hank Miller, that's with me here, he's the actually engagement partner, and he's in charge of the audit. I am actually not an engagement member, and I'm not forming the opinion. Actually, Hank forms the opinion. My job is to help prepare the financial statements to get them in compliance with GAAP. The way the new yellow book standards we have to have that segregation. So he's in charge of all the engagement and audit team sides and giving them opinion units and whatnot, and I'm helping to assist the district in preparing their financial statements. We get into the financial section, which is the independent auditors report is on 8 and 10. And that's your main report that you're looking on. What that report is opining upon is the basic financial statements that you'll find on 21 through 34, and the notes to those financial statements from 35 to 82. So we are opining on the statements that they are materially correct. Okay, that from a financial statement readers, some of the financials can read those statements and relatively certain that they're correct, right? There's no major issues. We're finding material weaknesses that they're materially correct. The required supplemental information is stuff that's required by GAAP, and they're mostly your pension and OPEB schedules of your long-term liabilities and government financial statements. I would like schedules on that from the actuary reports. The supplemental information section, you'll get a more detailed breakdown of each fund and all the various expenditures broken down by more categorized departments. So all the supplemental information is combined up into the basic financial statements. And then you have some other long-term debt schedules that we provide. And then you get into the single audit section. The single audit section is you're going to see 2 reports from us in there. Not only do we got a test on the financial statements that they're free from material statement, but we have to attest on internal controls on the financial statement. And that's the GAGAS letter that's in there. And we also have to report on the uniform guidance of federal compliance testing for the single audit for all federal programs. We got to make sure that the money is spent properly. So you can think of it this way, the independent auditors report on uniform guidance is, did you spend the money when you said you're gonna spend it? Right? And under the government auditing standards is, do you have the control, the internal controls in place that there's not gonna be any issues? All right. I'm gonna leave the next section, to talk about the management letter and the findings, for the Hanks. Tell you what needs to be discovered.
So I'm gonna put you guys to page 2. That's where the main letter is, like Bill said. And you can read through some of this. It basically outlines one section you see what management is responsible for, and that's selecting and using appropriate accounting policies. But I want to point you to page 3. So this letter is, right now we have pages 2 through 6. That's the whole letter. So on page 3, there's some key definitions in here. So when we do discover issues during the audit, we will disclose them in this letter. And per our standards, there's basically 3 definitions for what some of these issues could fall under. So there's, at the lowest level, there's a control deficiency. The next level is a significant, and I'm looking at on page 3, this is the bold print there. So there's a control deficiency, a significant deficiency, and then a material weakness. And in this letter, we explain basically what constitutes each of those types of issues that we find. So a control deficiency exists when a design or operation of a control does not allow management in the normal course of performing their assigned functions to prevent, detect, or correct misstatements on a timely basis. Next, a significant deficiency would be a deficiency or combination of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. And then a material weakness is a deficiency or combination of deficiencies in internal control, such that there is a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis. So just to go through some of those definitions, or just explain some of the definitions for you. On page 4, we'll see this is the section where we basically outline some of the issues that were found during the audit. So, and this will be listed from those of most importance to least important. So we're going to start with material weaknesses. So we had one material weakness, and that was with accounts payable in the general fund and in the food service fund, where when we arrived for our regular audit, accounts payable was not reconciled, meaning that management wasn't able to provide us with a detailed breakdown of what exactly made up accounts payable to the dollar. So, and we detailed some of that information in here. So initially there was a discrepancy of $31,000 in the general funds that eventually was resolved and it wasn't an issue. The reason for the management note is that it wasn't initially reconciled on a timely basis. So when a district closes out its books, accounts payable is one of those items that should be reconciled along with most of the balance sheet accounts. But the reason it's material weakness is accounts payable can be a large item on your balance sheet. So if it's not reconciled, there could be large discrepancies in there if they're not discovered, if it's not reconciled. So that's a major account that could be an issue. So the main point of why we bring it up in the management letter is just to note that it should be reconciled on a timely basis. And there's almost always going to be some issues with reconciling those accounts, but those issues should be resolved as soon as possible.
It also should be noted that under GAG's government auditing standards, we don't get to choose if it's material or significant. Even if we believe it was only off $31,000, that's not material to your financial statements. But because it's not reconciled on a timely basis for government controls, it's a weakness in the internal controls, and we automatically have to make the material as weakness. So just keep that in mind. We don't get to choose to bring it down to significant, because accounts payable is one of those accounts that they determine that if controls aren't set up properly, that there could be material
in internal controls. And so that, I was just going to the last section under the general fund and food service fund accounts payable. We just give our recommendation that should be that all balance sheet accounts and all funds should be reconciled at year end. And that reconciliation should be provided. You should be able to provide that reconciliation to us, the auditors, so that then we can rely on that reconciliation and what makes up that balance to do our test. So next, that was the one material weakness, and then we had a couple significant deficiencies. So these two items are pretty much, they're very much related to each other. So Bo mentioned GASB 84, which was the new standard that was implemented last year, the county standard. And that modified how student activities were reported, or agency funds were reported. They're not called custodial funds, and depending on the amount of control, one of the factors is depending on the amount of control exerted by management determines whether it's a custodial fund or whether it needs to be reported in general fund. So a prime example is a lot of elementary school activities. It's pretty much run by the administration. It's not run by students like it would be at the high school. So because there's much more control exerted by management or administration, it gets reported in the general fund now. So part of the issue is the school district did go through and identify those activities and trust funds that they thought belonged in the general fund versus should remain as custodial funds. And then they were reporting the activity in the correct funds. The issue that we had when we arrived at the audit was there's an issue with reconciling cash. So now you have an instance where you have elementary school, as an example, elementary school activity funds being reported in one fund and the other activities being reported in the custodial fund, but it's all still being held in the one cash account. So you have what we call pooled cash. And so one of the issues we found was that the pooled cash wasn't being reconciled for each. So how much of the activity funds made up the general fund portion of cash versus activity fund portion of cash. And so that's the first note you see there. And then to go along with that, the second note is the implementation of GASB 84, which I sort of covered, where management did go through and recognize or identify the correct activities that needed to be reported in the appropriate funds, and they did report that activity, but there were some additional entries that needed to be made to bring in those opening balances. And so you guys can read through those in more detail if you have any questions. But now if we go to pages 5 and 6. So these are control deficiencies, which would just be some sort of deficiency in an internal control that could result in errors, but is certainly not material, or may not have a material effect on the and most of these will just be pertinent, I would say, for management. We make recommendations for things that they should do to improve in these areas. The first one is invoice approvals for capital projects. So that's just making sure that management is signing off, or there's on the actual invoices. The reason that's important is when an invoice then goes to accounts payable to be paid, that the person who's making or processing accounts payable should be looking for the approval from management. So that way, if they're used to just getting an invoice taken out, they could pay an invoice that either is incorrect or if there's some issue with that invoice, and it may get paid erroneously. The next one is issue with the food service fund and the bank reconciliation. I think the main issue there is that the reconciliation just wasn't done on a timely basis. However, it was reconciled by the time the audit was. The next issue, this one's a little detailed. So I'll try and explain it. basically what happened in the food service funds is there were donations that either students or teachers were making. So if a student had a positive balance, they wanted to donate their balance to students with negative balances. So there was just an issue with the way that was posted in the system, where those kids who were donating their balances, it got posted to a revenue account. And really what should have happened is it should have remained on the balance sheet, and then however it was determined through management that they were going to apply those balances. Once they determined how they were going to apply those balances, then they go through and they can post it in the accounting system. Well, in the, I guess, the POS system, and just apply those balance internally in the, I guess, the POS system. And there wasn't necessarily an entry that needed to be made in the, from that accounting perspective. So, and we sort of detailed some different options for how that could have been reported, just for future reference. Any questions about that? The next one's a minor one. This has to do, we call it a master salary list. Basically, what we're looking for in the audit is we're looking for, so you have a HR department and you have a payroll department. So what we ask school districts for is we're looking for a control list outside of payroll that details everyone's salaries and pay in the school district. Sometimes we can get that from HR. With smaller school districts where HR doesn't carry that function, hopefully we can get it inside the business department, but outside of the person who processes payroll. And what we do is, for the audit, we like to compare that control list to what people are actually getting paid. And we pull a random sample of pays, compare it to that control list, and just to make sure that there's no funny business, or there's no mistakes, or people aren't being paid the incorrect amount. So that's basically what. So that's basically what this note is referencing here. One suggestion, I think in the past, I might have made this Sandy, was I know there's budgeted salaries reports that are done at the beginning of the year. And so the issue here is that payroll is involved in that process for the pays coming up for the new year. And so that's fine in a smaller school district. It's hard to have that complete segregation of duties. But when our suggestion is when that initial list is created, if that list is reviewed by management, approved by management, and then that's maintained in an area where payroll cannot touch it. And then there can be, obviously payroll is going to be updated throughout the year, and we can get those reports from the system. But to have a unadulterated control list, it just helps with the audit process. All right, so next, general fund tax collections. Basically, there were just a few coding errors with taxes, and we did discover an issue where a tax collector had overpaid the district in December. And since we found that, and it was still go back to the tax collector, we had to disclose that. And the last issue was inactivity funds. Basically, the revenues should be coded a little bit more descriptively. So most of the revenues were being posted to $69.99, which is a miscellaneous revenue account. But there are various accounts, most of them in the 6700s, that they can be broken out to provide further detail, or more descriptive detail for the financials. So that's basically our recommendation. And then the final part of the management, another thing I want to point out with the management letter itself is you'll see here in other information, we're disclosing leases. So any new accounting standards that are going to be implemented in the future will be disclosed in here as well. So the big one for this year that you're in now is GASB 87, which deals with leases. So we just disclose that information here, so the readers are aware. Any questions about anything that we discussed?
I don't. Anybody else?
No, most of my questions will probably be directed towards Dan. Well, I don't really have questions for Gorman right now.
So all we do badly.
You know, they,
You know, I remember a few years ago where we did have some issues, you know, I think it was 3 years ago, we had some significant issues. And,
the major ones is the material misstatement and then 2 significant deficiencies.
Mhm.
Those are added with the correction action report, and Dan has responded to the corrective action report. You can see the back, it's gonna be the last of the page of how he's gonna, of what he's gonna do to get those things corrected.
Right.
So,
Perfect.
So if you look on page 119, we have the schedule of findings and question costs, and then on 121 is the corrective action report.
which is kind of like the mirroring that of the responses, how he's going to do that. And that's required, but anything, the control deficiencies are not required to be reported to the federal OMB or anything else. That's really just for management. So use whether control deficiencies is significant and material weaknesses, though in material controls are reported on that. And that's why I bring the action plan. Those ones. But the other ones are, those are minor, call minor deficiencies.
Yes.
Are more like recommendations by us.
Yes. Well, I can see that some of the accounts, you know, from what we had seen over the past few years with the changes in the student accounts and things like that, the scholarship accounts going from one account to another. I can see how that happened, and I can see that we're going to be fixing that going forward.
Yep,
So,
so, you know, one thing we do have disclosed is, you know, obviously it's. Come on, reports, we did have difficulty getting through the audit. I know they had a bunch of staff problems and going through, so it was an issue. We did get it done, but, you know, it's gotta be up there, we should be getting this done, like, we were lucky this year that we're not gonna have another finding. We're not getting the federal clearinghouse. But they did postpone it for COVID. So we're just still in compliance with federal testing, so there's no issue there.
Yeah, there's a 6-month extension this year to submit this in audit reports.
So we have that, but, you know, we'd like to get this back in December. Get the reports out. But
And I'll say it will be.
Okay. All right, so do you guys have anything else for us that you want to go over, or are we letting you go?
sure we bored you enough.
No, I think we're good.
Thank you very much.
Yeah, thank you very much for coming. I appreciate that.
Our pleasure.
Thank you.
So Mrs. Cunningham, I did have a couple questions with regards to the findings. If is now an okay time to
Yep.
address?
Good time.
So, under the material weaknesses, the accounts payable general fund discrepancy of $31,212. I understand that they just said that that was resolved, but what was that $31,212? How did that discrepancy occur?
So most of that, I think, was a result of prior year adjusting entries that weren't reversed. So as essentially, normally in your accounts payable, you'd be able to see here are the number of bills that you've paid after June 30th that were really for the prior year. And so that would make up an accounts payable balance. So it's something that at the end of the year was payable, and then you would pay it after June 30th. So that balance at June 30th should be relatively easy to reconcile when looking at the payments that you've made that were really from the prior year that cleared after the year. Does that make any, I don't know if that part makes sense or not. So if essentially, if Gorman came in, they did work in June, they invoiced us in July. Well, it was June work that they would have completed. So that is a payable at the end of June. If we pay them in July, what it appears on the financial statements is as in accounts payable. That's an accounts payable balance to pay them for services, and you're going to be paying them in a future period, in a future month. Essentially, when we looked through that and in reconciling it, we were off by this amount. When we looked into it a little deeper, and part of this, Megan was involved with, was finding that variance, because I stared at it for too darn long and it wasn't jumping out at me. What it was were, there are adjusting entries that the auditors make as part of their financial statements. So anything that we would have had any differences, they provide us with journal entries and we post them to the account. Some of those reverse in nature because it's just a timing difference, that instead of it occurring in the 1920 school year, it then reverses in the 2021 school year. If those aren't reversed, your balances will be incorrect. And so there were a couple of entries that were not reversed from the prior year that should have been, which threw off the balance in the accounts payable account.
So if you're okay with it, I'm gonna
Mhm.
repeat back to you what I
Sure.
think you said to make sure that I understood that. So basically what it was money that should have been taken out of accounts payable in June. But we didn't have the invoice yet, so it didn't come in until later. You eventually have to take it out of your ending balance over here. And maybe perhaps you did that, but it was also coming out in the new year?
The
Is that what you're saying? Like,
No,
you
so
kind of
this-
getting taken out technically, number wise in 2 different months?
right, so not
No?
not quite.
Okay,
So yeah,
Okay.
so we would have let's see, the easiest way to do this is to actually show the reconciliation in all seriousness, as far as going through it, because a hypothetical is kind of tough to visualize, but essentially, if you had 10 invoices for $1,000 each, and they weren't paid by the end of the year, but they were for work that was completed during the year, you would have those 10 invoices in your accounts payable balance, and your balance would be, say, $1,000, $10,000. That's on the basic level of it. There's $10,000 balance in accounts payable. If, however, your beginning balance from the prior year was incorrect because you didn't reverse a prior year entry, instead of having $10,000 in there, you could have $40,000.
Ah,
And so the balance at the end of the year says $40,000. And when we look at the actual checks that we cut, it should be 10,000. Why is it 40,000? And so that's where the reconciling item comes up, where we're going, where's this $30,000 coming from? We only have $10,000 worth of checks that should make up that balance. Where's the other 30? And then as we walked through it and kind of dug deeper, it was actually a result of a journal entry made due to the prior year audit that should have been reversed in 2021, and it wasn't.
okay.
So it had an incorrect balance pretty much throughout the year, because that entry should have been reversed essentially July 1st.
Okay, now I got it. Thank you. And then, for the food service accounts payable for the end of the year, the audit said that the information was, inaccurate, and then it basically wasn't available. Like, we didn't know why the end of the year accounts payable was, inaccurate. You weren't able to tell the auditor at the time.
Correct.
So is it now balanced? How did we resolve it? And what actions are we taking to prevent that from happening again?
So it's similar issue as far as the reversal entry wasn't made. So prior year entry was made at audit. That would set us up for basically for the June 30th financial statement. But because the timing difference between when we are getting the journal entries from the auditor, and how we've booked those certain entries from July through November or December, we may have been booking them a certain way, and we should reverse their entry essentially to true up the accounting, and that reversal didn't happen. So similar to the general fund, as far as the steps that we're taking to correct it, and this would apply on the general fund side as well, would be taking their suggestion and actually having this reconciliation done on a regular basis to make sure that we know what the balance is in the accounts payable, both on the general fund side and the food service side at all times. So we'd be able to see, okay, what's the makeup of that accounts payable balance, currently. We'd be able to reconcile that and say, okay, well, here are the checks that make up that balance. As far as, there's another piece to food service that does come in. So we treat, everything gets booked as an accounts payable into a single account. When there are different types of accounts payable. And so if it's payable to the Western Center, it's a separate account. If it's payable to the general fund, it's a separate account. And what should happen is at the end of the year, as we're booking this into a general, a single accounts payable, we make adjusting entries to correct that because it shouldn't be in one single accounts payable account. It gets broken up into intergovernmental payables or so we know what those balances are. That entry just needs to be made. And the issue was that the entry wasn't made prior to the audit. So when they came in, they said, well, here's your accounts payable. That's not the right balance. It should be, part of it should be in this account and part of it should be that account. And they shouldn't have to do that. That should be something that we handle from the bookkeeping side and the business office side prior to them arriving. So then we can say, here's the accounts payable balance. Here's what it's made up of. Governmental balance, here's what it's made up of. That's essentially the steps that need to be taken during your call to the 21-22 audit, which is yet to be scheduled, but will probably be in that October, November timeframe.
October sounds good. The pooled cash, have we set up, they recommended like a whole separate account, I think, like a whole different account. Did we get that set up
It is
yet?
also,
Good, okay. PAF. Do we finally have that all correct? On that?
yes. I don't know if that's, no, okay. So yeah, as far as what Keith recalls is we went through and we identified what scholarships and what activities are student activities and what need to be pulled into the general fund. Those have already been taken care of, and the transactions were booked appropriately, I guess, with the exception of if they're going to say, their suggestion would be to break down some of those $69.99 accounts into something a little more specific. So we're taking steps to identify those particular revenues and break them up separately into more detailed accounts. As far as the pooled cash, like I said, that still needs to be bifurcated essentially into two separate accounts. And then with the adjusting entries that Gorman has provided, that has cleared up the beginning balances that were incorrect from the beginning of the year. And so that is being accounted for correctly and reconciled on a regular basis.
We're about to end this fiscal year. So will we have all of their recommendations done prior to closing out our books on June 30th?
We'll have it reconciled prior to them getting, I will say that. So
Okay.
June 30th, that is the end of the fiscal year. We do have time to, in that point from June 30th, we do an internal review of the financials to make sure that that from our vantage point, everything looks appropriate and proper. With having their recommendations, we'll also be able to apply their recommendations and while reviewing the June 30th financials to make sure that it's ticked and tied prior to them arriving.
And then one last question that most of the little ones at the end, at the end, the control deficiency, if I wasn't too concerned about, except for the food service donated
Mhm.
student funds. Because I know a lot of people that did that, including, I believe I did with my daughters who graduated balance. have we set up a good plan for making sure that that money is getting to the kids who need it and not coming out and going into a revenue fund?
Right. So I will say it was going to the students. I'll clarify on that. So it was being applied to the students' accounts. However, instead of being booked essentially as
Transfer.
it's an unearned revenue account at that point because the service hasn't been provided. So it would sit as basically a liability. It was being booked as a revenue, which, you know, is clearly an improper way of treating it. It'd be no different than if, you know, if my son, I wanted to put $20 on his account, if I give him $20 and he puts it on his account, well, the district hasn't earned that yet because he hasn't eaten $20 worth of meals.
Mhm.
So the $20 isn't revenue until he eats $20 worth of meals, and it's essentially revenue every time he goes. So when he goes and gets a cookie for 60 cents, the district just earns 60 cents of that $20. So it was being applied according to the policy, which it's, I don't remember the policy number right now off the top of my head, but it gets applied to students' balances in a particular way. And I think it takes into account the free and reduced status of students. Free in the sense that they
Right.
need the funds, but the reduced status. And then from a low to high balance, I believe. So if somebody were to owe 30 cents, it's getting applied to the 30-cent account before it gets to the $50 account that may be outstanding.
Good. All right, thank you. That's it for the audit questions from me.
Okay, Keith, do you have anything?
No, Judy covered most of them, and actually one of the ones I was most interested in was the student negative balances, how they're being handled and things like that, and Dan just explained that.
Okay,
Expected anything that we've notated here is material weaknesses that Dan and the staff will be rectifying that over the next few months, implementing the fixes and tracking it. You know, and as I said earlier, you know, some of the issues that we had were the fact that we were trying to adapt to the changes in the accounting standards that occurred over the past 2 to 3 years with the student activity funds and everything. So I don't see that as a significant fault for us. You know, I think that is something that probably could have happened to pretty much any, and probably did happen to a lot of districts. So I think comparing this to what we had over a few years ago is a great improvement. You know, it looks like we're doing much better than we did a few years ago when we had some significant issues. One of the things I will say is they mentioned about the control for the wages and salaries and the approval of invoices before being paid. Do we have anything in our systems that we might be able to implement to where we get all the approvals for the invoices before going out? Like, you know, I get an invoice from my vendors, I submit it to our secretary, she puts it into a DocuSign.
Sure.
Basically system to where it has to follow a workflow and everybody has to do it, and you get rid of the paper and you get notified of when all the approvals have been reached. Do we have anything available within our system that we might want to look at trying to implement over the next year or two so we can?
Yeah, we absolutely do.
Because I know that there is you've said it before, that there are a lot of features that we haven't tapped yet.
There are functionalities in there. And so where this particular control deficiency is with specific to capital projects. So I'll say from a general fund side, everything goes on a purchase order. So there's approval to make that purchase. And then when the invoice is received, it's initialed on, and it's a hard copy. It's initialed and it's submitted for payment. And essentially, as long as there's not a difference between the approved purchase price, you know, the amount that's on the PO and the invoice, it's going to get paid once we have basically identified receipt of the goods or services. So that's happening on the general fund side. On the capital project side, since it is a smaller number of transactions and it's very closely held essentially between myself and Megan, and previously with Sandy and me, that process has kind of been hasn't been enforced, and it's been relatively loose in the sense that once it's, you know, if I see the invoice and I take a look at it, I just give it to, I can give it to Megan and she pays it. I know I had eyes on it. And so that's been the practice. I did note down here, initial invoices or actually POs. POs would be the systematic way of doing it, which I think would be the long-term plan on doing that, opposed to, if I get an invoice for the Giza project and I just write my initials on it, I mean, that's great, but that's hardly proof of anything. And so while I think that would suffice this particular control deficiency, I think we can do one step further, which would be doing the actual PO and doing it systematically, opposed to, me writing DCD on an invoice. And is there another one there? The master salary list.
They were talking about.
So this has come up year after year. And every year I get asked for it. And every year I say, we don't keep a master salary list. We did away with that in 2015. It appears that they've been getting some sort of master salary list, and because this hasn't been a control deficiency in the past. So that was one that I was not aware that they were getting that information some other way. So as far as what we're doing to remedy that is actually creating a master salary list that we'll keep on file, that'll be outside of the grasp of payroll that we have that from the get-go, so they'll be able to compare as they put it, an unadulterated version of the salary list to the actual payroll records. So I will say that that's part of where we are currently with budgeting for 22, 23. I may not be able to get that for 21, 22. I will be looking desperately to try and find if there are other files out there that were saved elsewhere. But that's one thing that you can't really go back and recreate, because it defeats the purpose of what they're trying to get at, which would be, this would have been something that was created 12 months ago.
Okay. Keith, you done?
Yes.
Okay. JP, I see you're there. Do you have any questions?
No, all my questions were covered by Keith and Judy, so I'm good.
Yep, I think mine were as well. So I guess we can put our audit behind us.
Dana's here.
Dana is,
Do you want to ask Dana?
Oh, I can't see him. So Dana, you have any questions?
I wrote for a reason.
Oh, no, I don't think he has no questions.
Okay. All right. Well, then I guess we'll wrap up our audit from 2020, 2021 and move on to next year's fund budget.
Melanie, can you see the
Yes.
presentation?
Yep, I can. Thank you.
So this would be a discussion over the final budget revisions. We did have department budget meetings last week and made some changes to some of the expenditure side and some of the revenues. So walk through similarly like we've done in the past. The timeline, the number of items here keeps getting shorter as we get closer to final budget passage. So we'll be discussing the adjustments this evening, and then there will be a motion on Thursday's meeting for the adoption of the final budget and the adoption of the homestead and farmstead exclusion. And then just to note here, June 30th is the deadline to actually adopt all of these. So we'll be doing this on the 16th.
Okay.
So this slide probably looks familiar, although the numbers have changed a little bit. So the revenues are up about $113,000. We made adjustments to the interest revenue and the earned income tax based on trends and based on rate increases. and expected Fed increases for interest rates. We did increase the interest earnings projection. And then same as looking at where we're trending for earned income tax, where wages are going opposed to where they were in the past.
Dan, can you just move to the next slide? I can only see the first one.
Oh. Would I? Maybe it's because I'm in the presentation.
Sorry. I was waiting for it to change and then it didn't. I'm like, wait a minute, I can't read that. It's too small.
Is it still not changing?
No,
All right,
sorry.
let's just go back and maybe we can do it this way.
Okay, now it did.
Good.
Yep, thank you.
Sure. Sorry about that.
It's okay.
So as I was saying, revenue, we did increase the revenue line items for interest and earned income tax. And then we'll go through a little more detail on the expenditure side. There was almost a $278,000 decrease in the expenditures. And it's not all expenditure or all decreases. We've had some changes and decreases in our UPOLA, the E-rate. As we discussed during a previous meeting, we've kind of budgeted as the gross expenditure amount, and then through the E-rate program, we basically get a reduced rate on some of our technology purchases. So that was essentially a $62,000 decrease in the expenditure line item. Other decreases were in IT supplies, the feasibility study that we're currently working through, and the cost of the feasibility study could probably just be pulled out of the capital reserve as it's being crossing years. It became a little difficult to manage on the budgetary side. And then we had some changes in the special ed pupil services area, particularly for changes in placement, as well as GHR nursing services that we had incurred due to some additional COVID testing and assistance. I would be remiss if I didn't say that we also had some increases in the expenditures, particularly to fuel costs. Those are up. They're up higher than the initial extra $100,000 that we had budgeted. So that is a sizable increase. And then additionally, the salaries and benefits changes that were a result of the changes in the compensation plans, and also the communications position going full time. So here's an updated fund balance projection. You may recall we were projecting 21-22 of having a surplus of roughly $490,000. We just reran this for the end of May, and we're projecting roughly $163,000. The big portion of that appears to be an IT purchase that for devices that, due to supply chain, we didn't think we were going to receive those by the end of the year. And so if they were received in July, they would have to be a July expense, even if we placed the order in January, just picking an arbitrary date. So regardless of when they're purchased, it's when you take receipt. However, those devices did come in, so we've incurred that expense in the given year, so that surplus of the $490,000 was reduced down to the 162, largely because of that, and then some other changes as far as additional purchases. So as you work down this, then we're looking at the 21-22 projected fund balance of $18,102,383, and then projecting the use of fund balance that you saw on the previous slide of the roughly $3 million would bring us down to a projected fund balance at the end of 22-23 of just over $15 million. Julian, I can share this out too. I see you writing vigorously there. I
Oh,
I
that
can
would be
share
great.
this. Yeah,
That would be great.
Yes, that also.
yeah, not a problem.
I think we were all.
No, no, it's-
Virtually nothing new.
I wasn't looking up. I looked up and I saw everybody writing. So this is the graphic that we've been presenting. Sorry, Melanie, I have to move your. So essentially, in the revenues, it's the local revenue that has changed, the local revenue relating to the interest income and the EIT. So this $45 million amount has been increased to account for the additional interest and EIT projections. This particular slide includes the 2.5% millage increase, which note down here is 1.35% tax increase. I'll clarify that what we were discussing previously and what I discussed with the committee and the board as a whole, the 1.35% tax increase is on the taxpayer side. It yielded, basically a 1.21% increase in revenue to the district. And so I was taking that, that vantage point when previously presenting this. So I want to make sure that that it's clear to the committee where 2.5 is a 1.35% increase to the taxpayer.
So the same millage and tax increase that was discussed and approved at the May 12th meeting is the same that people are going to see come Thursday? Or is that still to be determined?
I will say that's still to be determined. I'll present that to the committee very shortly with a future slide here. So general fund expenditures. This is just updated for those changes. Like I said, roughly a decrease in total expenditures of $278,000. And it's predominantly in that instructional area. So the largest piece of the pie. And so total budget expenditures at this point, $72,353,666. Updated this slide. So previously it was an increase of about 1.9%. With the decrease in the expenditures, we're keeping the expenditures as close as possible, given that we've added a number of we're adding a number of positions, and so the total increase from the 21-22 budget to the proposed 22-23 budget is $1,077,348. And so here is a slide that we've seen as well, and although it does look a little bit different, this includes the additional change in salaries as a result of the compensation plan adjustments, as well as the communication specialist. So the up top here, you've seen the learning coach, the student assistance counselor, BCBA, and the HR administrative assistant. The director of transportation registration previously was, and the registration and transportation administrative assistant. Those positions were detailed here as far as other adjustments as needed. These were part of the board update last Friday. So part of the increases for those particular positions, registration, transportation administrative assistant moving from part-time to full-time, and the transportation coordinator assuming additional responsibilities and of managing the registration function and being retitled and for director of transportation registration are listed here separately. And then, as I said, the communication specialist, and then the paraprofessional, custodial, and food service adjustments for those.
The bottom two that added any funds or any dollars to this change, the bullets all above were in the initial budget consideration.
Yes, it is these bottom two bullets. The two above were already included in the figures, just not in title.
So that's an addition of 8 personnel, either adding personnel or changing to full-time, correct? So it's actually 7 additions and 1 full-time?
Well, and the change in salary for the bottom one, paraprofessionals, custodial.
Right.
They were not actually adding
Okay.
any new
So
people,
6.
just increased their compensation.
I have 4 new,
Right.
2 half to full, 1 adjustment, and the bottom is the,
Okay,
compensation, about 185, 195,000.
Yep,
For recruitment and
Yes.
retainment. So I have 4, 2, 1, and then the adjustments.
yep, that's like to me.
So this previously was, it was a $460,000 line item up to $745,890.
Yep. I thought it was 460. That's what I was looking at and thinking, wow, that's a lot.
This is it's a placeholder for the same slide that we've seen for facility upgrades that are in the budget and are projected to be complete during next year. And so,
So Dan, they're still in the regular budget then?
yes,
Okay. All right.
These aren't coming out of capital?
No,
these are in the
Okay.
operating budget.
they can come out of capital if we want them to. Correct?
Yes, yeah, they can come out of capital. I guess my overall concern on pulling them out of capital would be knowing what we probably have coming down the pike as far as a feasibility study and any findings that we would like to address that major in nature. You know, if they're small dollar ones and they're relatively quick fixes, that would be one thing. But you know, truthfully, I'd like to, you know, promote the idea of building these into the operating budget, the general fund budget, and waiting to get the findings from the feasibility study in October, November, December, and really game planning for the use of the capital funds strategic.
Yep. I agree. I was just thinking in my mind that those, if they were taken out of capital, kind of makes up for the other, in addition to the 460,000 for the staff that we changed.
Sure.
That's all. I didn't mean that we had to. I just was thinking about it.
Sure.
The weld exhaust for the X lab, is that coming out of capital or are we hacking that onto here?
We're planning on having that come out of capital. That was one that kind of came up, was more expensive than previously, but more entailed, and seemed like it would be a
that's
project.
different from the
plan
X
for.
lab ductwork.
It is different. There are 2 different ductwork.
Yes.
I've had to clarify this numerous times. Wait, Doug, these are 2 different ductwork projects.
Yep. Yeah, they are.
Draft motion on Thursday's agenda.
For the welding vent.
Yeah, this
Yes.
is
Fume
the,
extraction?
Understand. Motion to approve a contract with Burkhart Mechanical for the high school X-Lab welding exhaust system.
this is the dust collection system
Yep.
that apparently the ductwork needs to be rerouted in some way. Yeah.
Yep.
So Dr. Roach kind of alluded to this as far as what was presented on a previous slide for the 2.5% millage increase. What that yields is at $463,000. That was essentially to cover the increased salaries and benefits that were discussed previously. I did add a 3.2% in here to try and find an amount as close as possible without coming up with wonky percentages that PDE will not accept. I tried that once and it wasn't going to work. So 3.2% results in $736,000 worth of additional revenue, which would get close to the $746,000 here for the additional personnel and adjustments. I knew that the committee had discussed it previously, and I thought that the idea behind the original 2.5 was to essentially cover those ongoing expenses from the personnel side. Since we're making that investment in our support staff, our paras and our custodians, I wanted to present that to the committee and show what that would look like to fund those commitments for wages.
Okay,
And then this is to show it a little differently. I will point out on this slide, I do have it rounded, so the 1.31% is 0. You'll see here, just for full transparency, it's really $19. So, but for argument's sake and for presentation purposes, I wanted to make sure that it was as close to 0 as possible. But from here, you'll see that it's really negative $19. Just don't want to have any confusion on some of these things. So that 2.5% is a 1.35% tax increase. It yields $463,272 worth of additional revenue, and this would be the effect on the median homes in both Berks and Montgomery. And then also you'll see down below the 3.2% millage increase results in a 2.04% tax increase. It yields the $736,087, and the increase on the medians are listed here as well.
And by any chance, do you know what the median values are right now?
I do, and it was on a previous.
Don't worry about it.
No, it's 99,500 for Berks and 110 for Montgomery. I'll get those specific. They were
That's fine.
on the previous one.
Was that 110 for Montgomery?
Yeah, it's 110 or 108.
No, it's okay, don't worry.
I'll get it before
Ballpark figures
I'll get it
you-
before the end of the meeting. So,
It will be a question for Thursday night.
yes, it will.
yes, I'm sure it will.
Just
Yep. So I'll add those back. And then here are the same figures, just on the average opposed to the median. Slight changes. So where it's 4202, it's 4292, and where it was 6364, it's $65. So, but yeah, I'll update this so that is clear on those values.
Okay, great.
So as I said previously, at the beginning of the presentation, we'll have a motion to adopt the homestead farmstead exclusion, also as well as the budget resolution. And I guess I would like to ask the committee, their feelings on the changes that we've implemented as far as the additional salaries and positions and benefits that go along with that. That when looking at the increases over the 2.5 or the 3.2, the 3.2 is going to get us to basically cover those ongoing expenses. I know that's something that was discussed. While not an overly popular proposition, I do think that this would be in line with what the committee was considering previously as far as continuing to support those ongoing expenses. So I wanted to see the committee's opinion on the possibility of moving upward to the 3.2% millage increase to fully fund those additional salaries and benefits, and just wanted to see where everybody kind of stood on that matter.
I can say I'm a firm no. Sorry.
Okay.
What was that last part, Dan, that she said no to?
I said I have to say my answer is no, and I'm sorry. It's a 3.2.
That would cover the
Okay.
additional salaries benefits.
Yep.
we'll discuss it.
What are your thoughts, Keith?
I'm along the lines of Melanie. Yeah,
Me too.
I advise that we go with the 2.5 to the board. That'd be our suggestion. I expect that some people will say even that's too high. I expect that people will say we should take some of those projects out of capital. So you may want to be prepared with some answers for that, some numbers for that.
I have to concur. I'd like to be able to say, we should cover all that cost. Unfortunately, I also have a fear of the bait and switch. We've had it publicized for, a month almost at 2.5. If all of a sudden we're like, oh, 3.2, they're gonna be like, whoa, 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 whoa. When I voted to approve these compensation plans and everything, I knew in my head, okay, we're gonna take more money out of the fund balance for these.
Me too.
Take any money out of the fund balance.
And we did some work. We did bring the numbers
I-
down.
Yeah, I mean, I'm impressed that we're down to only $162,000 surplus this year, but we were told we were gonna take about 4 million out of
4.7.
out of the
Yeah.
fund balance this year. So I think we're getting better, but we still have wiggle room there, I think. And we told the public 2.5 or less, because, I remember Ray Ann being like, remember, this is not, this is preliminary. So, some people might even be hoping it's gonna be less. I just don't think, that we should, up it at this time. I think I'm gonna use a Melanie phrase. I think we're gonna be okay.
Yep, I agree. We're gonna be okay.
I think we're gonna be okay. And if not, then we can try and make some more adjustments next year. We didn't even come, I don't know, what is the one index for next year? Do we even know yet?
Not till the end of June.
And we won't know the step until the end of the June.
Correct.
All right.
Yeah, I think that's the beginning part of July.
All right.
Yeah,
That's
Yeah.
But I think I'm good with the 2.5 that the committee.
That's fine. I wouldn't be
No.
doing my part if I wasn't pointing out that, I knew that the
We
committee
appreciate that.
wanted to fully fund those. I knew that we had these changes and I just wanted to make sure that, here was another % that would get us closer to.
I think we
to
all
fully
do the
funding
same
that.
thing in our respective professions. I go to my boss with, here's what we could do, here's what we should do. And here's what here are all the possible scenarios. Now it's your decision. So thank you.
Sure.
And we appreciate
Yeah.
what you do on this, the numbers.
So the committee's right
yep,
to maintain the same numbers that we had and were presented on June 12th.
Yes.
Sorry, May 12th.
2.5%. That's my recommendation. I
Yes.
believe that's key.
yes, mine too.
Because I made the original recommendation that we should cover the costs, which we thought were, roughly 460, whatever, at that time.
And we still are covering those costs. And like I said, when I know when I voted
Yes.
for all these additional expenses, I knew in my head that meant we might end up taking money out of the fund balance and have to make a correction next year for it. But I'm gonna wait and see if we actually take any money out of the fund balance.
Can I
There you
clarify?
go.
Yes.
Two things. Keith had asked a question. I went back and found it. So the median assessed value for Berks was 99.5 and Montgomery was actually 129.7. And then the average was 101,600 for Berks and 138,400 for Montgomery. And then the other thing you mentioned, bait and switch. I was accused of bait and switch with the masks and it didn't happen. The masks came off and they stayed off.
Yes,
No, I know what you're saying. I know what you're saying. I had PTSD from hearing those phrases. So I want to make sure that.
Bad choice. I'm sorry. But what I meant was, we did
I
present
know.
it to the public at 2.5. I think it'd be okay if we went down from there. I don't fiscally think it'd be okay if we went down from there. That's not what I mean.
Right.
But I mean, I don't think the public would complain if we went down from there. But if we
No.
went up from there, I think we'd have a harder sell. And it's hard enough selling that right now during these times with, you know, gas being as high as it is and everybody's money crunching. I'm very comfortable with the 2.5% for now.
Yep,
I just don't think we should go any lower.
no, I would love to go lower, but yeah, I don't think we can either. So I'm good with 2.5.
We have the numbers to update the agenda. Yeah. And we'll see it.
And what does the homestead farmstead exclusion come in at? The
Okay.
usual $180?
It's right around that. I just wanted to make sure that where we were with the 2.5%, I'll get those numbers updated on for the motion.
Okay, all right. That sounds good. JP, Dana, have any questions? Input?
Just overjoyed for 2.5.
Okay, well, that's good. That's good.
Why are you freezing?
I thought 2.2 is reasonable.
Like I said, I personally would be okay with the 3.2, but not as the president of the school board, I'm not, but personally, I'd be like, yeah, that's what I think.
Is there anything else we need to do for you? Get for you? Any
No,
other
that
business?
they give us the guidance to move forward with the motion for Thursday. And then
Okay,
for Thursday's meeting, the presentation, members may be a little bored at it because you'll be seeing essentially the same thing.
That's okay.
yep, that's fine.
We're listening.
But I'll try and maybe I'll be able to go through it a little quicker. So
I'm still working on my
since you guys
video,
have seen-
report.
How long?
We'll see.
Okay.
Oh, boy. All right, so does anyone have anything else for next year's budget?
No.
Okay, hearing nothing, I will say that our next meeting will be August 15th, and we'll decide what time. I'm gonna say it's probably gonna be at the same time, 7 o'clock instead of 6.
What is there?
What usually comes before?
We're usually 6, and then I think
Pol-
policy.
Policy first, yeah.
It's usually 6.
So 6.
So finance is usually 6 and policy is 7.
Okay, that's fine.
Big, right?
Yeah. And I,
Yep,
However, have we published those?
No.
No?
no,
So if the chairperson needs to change that time,
no, it's fine with me either way.
hey, just let us know.
You and Peg fight it out.
No, I mean, the plan is to maintain what we're
Yeah.
doing.
Right,
I
but
have the
if-
draft
If
here.
you, if you and Peg wanted to switch, I don't think it'd be the end of the world.
This is what, August? Okay.
Yeah,
I have
August 15th.
Finance at 6, policy at 7, and then facilities is the next Monday, the 22nd at 6. Those are the
Okay,
policy does can run.
Right,
long,
I think
so
that's why
it
policy's
probably-
always been
It probably
after.
makes sense to maintain.
And I've taken the end time
Finance.
off policy. It starts at 7, and when it's
that-
over, it's
that
over.
goes- That goes to.
Okay.
I'm saying 2 hours, but that wasn't, I mean, if it goes 2 hours, it goes.
yes.
All right.
Yeah,
next
right.
meeting.
Okay. All right. Well, that being settled, I would look for a motion to adjourn.
Motion?
Second,
All in favor? Aye. Thanks, everybody, and thanks for zooming me in.
thank
you.
you, Melanie. I hope you're feeling fine.
Yeah, I'm feeling fine. Going back to work tomorrow.
Oh, that's excellent.
Yay. Vacation's over.
What'd you say?
She's going back
I
to
said
work.
vacation's over.
I can take my mask off tomorrow.